Hi, my name is Sasha Stoikov, and I'm a senior research associate at Cornell Financial Engineering, Manhattan. And in my role, I've been advising students for the last 14 years on financial engineering projects. And because over the course of the 40 or so projects that I've advised on, I've realized that data has become more and more of a prerequisite for a successful project. And in fact, in the last 4 or 5 years, we've called these financial data science projects at Cornell Financial Engineering, Manhattan. So I thought that this conference, which focuses on big data and finance, might be a great venue to showcase some of the financial engineering projects we've done and give you an overview of the kind of questions that that industry as well as academia is interested in. So first of all, what are financial data science projects at Cornell? What do they look like? Essentially, they have three major components. First of all, we have a company sponsor that is in charge of sort of identifying an important problem in the financial industry and pitching to the students this problem. And the company also often provides data and guidance. Then there's a team of typically 4 students that work 4 credits on this project. And then there's a faculty advisor who is someone like me or a researcher at ORIE in Cornell who will meet with the students on a regular basis and sort of steer them in a direction that will help them fulfill something that is applicable to the company, but that is always also grounded in science. Now, what kind of projects do we have? Well, this year I took a few examples, and I'll give you a little overview of these 4 examples. The first two are sponsored by rather small companies that are hedge funds or startups. And the last 2 are sponsored by banks and large banks, and we're very interested in keeping a diverse set of companies, and they give a great diversity to the kind of problems we're looking at. So the first problem is about using NLP, so natural language programming processing, to classify companies in terms of their ESG, environmental, social, and governmental scores. The second project involves designing or simulating a market maker on cryptocurrency exchanges. The third one involves applying reinforcement learning to optimal execution and pairs trading. And the last one involves creating a framework to allow to quantify the relative importance of portfolio allocation and manager selection. So I'll delve a little bit deeper into each of these problems. And essentially, in the spring of 2021, the companies that we reached out to gave a 10 to 15-minute pitch of what the problem is and what is asked of the students. So the first sponsor, Alex Fleiss at Rebellion Research, came up with this idea of creating a dictionary for ESG investments. So in his hedge fund, he has found that there's a lot of traction towards and a push towards ESG, so environmental, social, and governance scores of companies. And he's also noticed that dictionaries are often used to algorithmically decide on the score of sort of sentiment score of companies based on text, and thought that it might be interesting to develop an ESG dictionary. So a dictionary that would allow an algorithm to take a corpus, maybe in this case, 10K or 10Q from a company, and assign an ESG score based on the words that they used in these filings. The second project that I'd like to talk to you about is in market making on cryptocurrency exchanges. This is the first project that we've done on cryptocurrencies. And Laurent Benayoun, who's a founder of Hedge Tech, put it this way: a crypto market maker, essentially who is executing trades on behalf of their clients, needs to have capital across various exchanges in order to provide liquidity to clients. So that means that every exchange, and some of these exchanges you may know of, like Coinbase or Binance, needs to have a certain amount of capital allocated to in Bitcoin and in USD. And the question is how to allocate and how much capital to allocate in order to avoid too much rebalancing across venues, which is a costly thing. The third project I want to talk about or mention is one sponsored by TP Enders at Goldman Sachs. And they have sponsored several projects with us in the past. And the goal this time is to quantify one of the sort of biggest dilemmas in asset management, is that there are essentially two decisions. One is the asset allocation decision. In other words, do I invest 70% of the portfolio in equities and 30% in bonds, or 60-40 or 50-50? And the other big decision that asset managers do is which manager should I select in order to manage various parts of my 60% or my 40% of my portfolio. And what was asked was to develop a simulation framework, and in order to quantify the relative importance of these decisions. And finally, the fourth pitch that I'd like to describe today was one given by Peter de Krem at Citi. And the idea here was that in data science, the technique of reinforcement learning has been extremely successful at developing AI for games. And the open-ended question was, how applicable is this technology to algorithmic trading? In other words, can we look at the market, in the intraday behavior of a market intraday, as a sort of a board game, and can we train algorithms to perform well on this board? So as you can see, these questions are often sort of aiming high and are rather sort of ambitious. And so basically the students are tasked to present or sort of analyze the data, create sort of theories, and then ultimately give concrete answers to the pitch questions. And so actually, as we speak, some of the students are presenting their final presentations. But in this venue, I'd like to give you a few sneak previews of what they've done. And hopefully this will give you an idea of the diversity of techniques that can be used in financial data science. So on the first project, the one where the students were tasked to build a dictionary for ESG investments, this involved a lot of scraping of data. In particular, the Edgar 10Ks and 10Qs for S&P 500 companies were scraped, and these large bodies of unstructured data were filtered for bigrams and trigrams, in other words, sequences of 2 or 3 words. And then independently, the students looked at an API on Yahoo that gave for each company a numerical score for the E, S, and the G score. So essentially the environmental score, I think it's a number between 0 and 20, and same with the social and governance score. And the idea was to identify the type of words that contributed to more positive scores and those that contributed to more negative scores on E, S, and G. And as you can see, by looking at the sort of this sample of the dictionary, some words, some mentions of commodity prices, natural gas, plant equipment, raw material tend to have a negative impact on the environmental score. And the intuition behind that is that companies that are in the energy field tend to score poorly in the environmental score. And there are a lot of other words that have impact on the social and governance scores. Now, how does one prove that this dictionary is effective or better? Because of course you can imagine there are many ways to produce such a dictionary. Well, ultimately, the students did an out-of-sample analysis of across various scores, the accuracy, the precision, and the recall, and found that if you took 10 Ks and 10 Qs out of sample and used the built dictionaries from an in-sample set, then the performances actually carried on into these other unscored companies. So this, in other words, validates the dictionary. And let me go on to the next project. So this one is the market making on crypto exchanges. And what you see here are simulations of the amount of dollars that a crypto market maker would have on a specific exchange, Binance, if they receive buy and sell orders from their clients over the course of a day. And so what you see is that often on normal days, the balance of buys and sells is sort of is a 50-50 balance, and the students were able to derive some capital constraints, or rather the amount of capital needed for in order to stay within certain risk limits. And what they then looked at is certain stress tests of, for example, a rally on Bitcoin or a crash on Bitcoin, which would be a very unbalanced set of client orders, maybe an 80, I believe it was an 80-20 imbalance of buyers on the right side, which essentially showed that although on normal days, a certain amount of capital might allow one to rebalance every 7 days, on very abnormal days, the rebalancing rate could be as frequent as every day. And ultimately, the results of the analysis were to look at various sizes of market makers, ranging from a small market maker that trades 1,000 trades per day to a large market maker that trades 100,000 trades per day. And based on the commissions that there is a recommended total capital to be allocated across exchanges and across currencies. The third project that I want to mention briefly is the portfolio allocation versus manager selection project, which essentially asked, what is more important, how much you allocate to, what your portfolio allocation is. And in fact, every color that you see on this graph represents 1,000 simulations of one allocation. Say, the light blue in the top right here is a 70-30 allocation. And of course, the axes are mean and standard deviation, the classic Markowitz efficient frontier. But what the students have done here is that for each asset allocation, there's a further 1,000 simulations where they go and randomly select a manager from a database of mutual funds in order to see how diverse the performances are for a given asset allocation. And so what you see is that sometimes these colorful blobs overlap a little bit, and those are cases where actually the choice of the manager selection matters a lot. And sometimes the blobs are quite differentiated from each other, indicating that maybe the portfolio allocation, a change of, let's say, 10% in portfolio allocation is much more important than that of choosing a manager. And finally, the reinforcement learning for pairs trading project, which in a way is an idea that attempts to take financial data and turn it into a game and train an agent to play that game. The students looked at intraday data of pairs of assets, in fact. So those are very co-integrated assets. In fact, they were, I believe, 2 and 3 times leveraged ETFs. And what we find is that if you regress the price of one asset against the other, the residuals of these regressions are good predictors of the next price moves at a short time horizon. So what you see on the colorful left graph, for example, is that over the course, what you have is on the x-axis the residual from this regression, and on the y-axis you see the changes in the relative value between the two assets. So what you can see is that certain horizontal lines seem to form, and these lines have to do with the microstructure or the granular nature of the intraday data. And from this, we're able to sort of discover that there are 7 main streaks, horizontal streaks, which encouraged us, or the students, to look at 7 buckets of relative pricing between these assets. And that is one of the ingredients of the state variable that you can see here. 421 means the residual of the regression is in bucket 4. The order book imbalance, another predictor of price moves for the first asset, is 2, and the order book imbalance for the second asset is 1. And as you can see, there's a rather this 3-digit number essentially tells our simulation, or rather tells an agent how, what state they're in. And that is an important ingredient in these reinforcement learning problems. And as a result, we can use the data to simulate pairs of assets, and we can simulate extremely large amounts of data, which is what reinforcement learning requires. And the output of this approach is that for every state, as you can see, the x-axis on the left graph indicates the state, and the color indicates the optimal behavior of the agent that has learned how to trade over time. So, and of course, afterwards, we can test these agents in out of sample days, and that is essentially what the students in this project have done. So hopefully I've given you a sense of how diverse data science, financial data science can be, and I've been very excited to work on these projects. Some of them have to do with NLP, some of them with reinforcement learning, some with clustering, and I found all of these very exciting. So so if you find these type of problems exciting and you'd like to be part of our FE project slates in 2022, I encourage you to reach out to me, sfs33@cornell.edu, and I hope you found this talk interesting. Thank you.